everyone. I'm William Luemba, and I'm a student of Accounting for Managers, Section 27, and I'll be taking you through activity ratios. Now, this presentation is divided into 4 subsections, broadly speaking. Section 1, we shall be defining activity ratios. Section 2, we shall be looking at the overview on activity ratios. Section 3, we shall do some calculations to lend us better context of what activity ratios, how they are calculated and what exactly they help interpret. Then we shall conclude the presentation. So without much ado, I'll start by exploring the definition of activity ratios. So activity ratios are referred to as financial metrics used to gauge how efficient a company's operations are. In other words, if you want to measure how a company has performed during a certain period, activity ratios can be very useful tools for determining that. Then the overview, we are going to specifically look at the activity ratios. That is, we shall look at accounts receivable turnover, we shall look at the inventory turnover, and accounts payable turnover. Now, for better context, accounts receivable turnover is useful in determining, or is indicative in determining how fast or frequent a company collects payments from its debtors. Then the inventory turnover is useful in determining how fast a company's inventory or goods are sold or bought by customers. Then accounts payable turnover is useful for, or is indicative of how fast a company clears its debts, what it owes its creditors. And the advantages of activity ratios, some of them include they facilitate management in as far as where to draw attention on the different items of the balance sheet. Should attention be paid more on maybe on creditors? Should attention be fixated on debtors? So activity ratios, depending on the outcomes of the calculations, they can lend you where the company is not performing well and where more efforts need to be put. Then they're also very helpful in terms of gauging a company's performance vis-a-vis competitors. Let's use the turnover ratio. For instance, companies which sell similar products, but you find that maybe company A, the products are taking a longer time than company B. That means company A is performing worse compared to company B, and which drives us to the third advantage. They are very useful for investors who wish to invest into particular companies. So if I'm an investor and of course I see company B is performing better than company A, I will be most likely I will put my investments in company B. So the disadvantages, one which is clear, is that these activity ratios are fixated more on companies which are into the production of goods. So you find that companies which provide services, these accounting tools may not be very useful to them. Now, to facilitate better understanding of these concepts, let us look at the calculations and how we can interpret these activity ratios. So we shall start by looking at the accounts receivable turnover and the average collection period. So as aforementioned, accounts receivable is indicative of how fast the company collects what is owed to it from its debtors. So this is calculated by getting the net credit sales and dividing it by the average net accounts receivable. So for this we looked at the Wiley exercise or the Wiley book, and we specifically looked at review problem 6, which gave us the financial statements of Canada Goose Holdings, and from that we extracted what is useful to us in as far as calculating activity ratios is concerned. But the question itself is also there. Section 2, the question, which is activity ratios, as you can see. The first one, which they wanted, was the accounts receivable turnover and average collection period. So to calculate that, we got the net credit sales, divided it by the average net accounts receivable. But for this particular company, there was nothing indicative of the credit sales which had taken place during this period. So the assumption was that all the sales which were made for that time were made on credit. So we got the cost of sales, which was for 2021, which was 349.7, and we divided that by the average net accounts receivable, which was 40.9, and it gave us 8.55 times, which is roughly 9 times. And to get the average collection period, because we are looking at the financial year, we got the number of days in the financial year, which is 365, and divided that by the receivable turnover, which was 8.55. So that gave us 42.69, or roughly 43 days. So which implies that the company took, on average, a period of about 43 days to collect its debts. And it did that about 9 times during that year, 2021. So we moved on and calculated the inventory turnover and the days it took to sell the inventory. So to do that, we got the cost of sales and divided that by the average inventory. So the cost of the average inventory, it's very important for us to understand what the average inventory is. And the average inventory is calculated by getting the opening inventory. We add it to the closing inventory, then we divide by 2 to give us the average inventory. So for this particular case, the cost of goods, the cost of sales already indicated or have already been mentioned, which were 349.7. Now, this particular question gave us the inventory of finished goods, which was 331.4 for 2020 and 259.9 for 2021. Now, because this is the manufacturing company, not all inventory is for sale. Some may be still under production. So to specify finished goods, that means the inventory which is ready to be sold to customers. So to get that, because we're going to look at 1 year where we have both closing and both opening and closing. Now the opening inventory for 2021 is the closing inventory for 2020. So we added that 331 to the 259, which gave us an average inventory of 295.67. So we divided that into the cost of sales and gave us 1.18 times. And to better calculate the days it took for the inventory to be bought, we got that inventory turnover, because as aforementioned, we're looking at the financial year. We divided it into the number of days in the financial year, which are 365, and it gave us 309 days to be precise. So that implies that Canada Goose Holdings produce took a period of about 309 days to be bought. And this is not a very strong indicator for the company, because it shows that the inventory took quite some time on the shelves before it could be bought by customers. So the other activity ratio we looked at is the accounts payable turnover and accounts payable period. Now, as aforementioned, this is helpful in gauging how fast a company clears its debts. So to get this, we got the cost of goods sold and divided it by the average payables. But again, the question itself gave us the opening and closing payables, which we used to determine the average payables. So if you look at subsection 2 of the question, activity ratios. Section F, to be precise, accounts payable turnover and accounts payable payment period. Assumed trade payables were 53.3 at the end of 2020 and 78.9 at the end of 2021. So we calculated the accounts payable turnover for 2021 after determining the average payables, which were divided into the cost of goods. So average payables were determined to be 66.1, and they were divided into the cost of goods, which have already been mentioned. And we got a figure of 5.29 times, which means that the company cleared debts about 5 times during that year. And the implication is that the company also took about 69 days, to be precise, to clear debts. And to determine that was determined by getting the number of days in the year and dividing it by the payable turnover, which was 5.29, and that gave us 69 days. So this implies that the company took 69 days to clear its debts. So in conclusion, the company's inventory took quite some time to be bought, and the company also, as indicated by the activity ratios, does collect its debts faster than it does clear what it owes. That is, in a nutshell, that's the conclusion we can make. It became very difficult for us to make conclusion in a comparative analysis or basis because we don't have the activity ratios for the previous years. With that, I want to thank you all for giving me your time and have a good one.